In this session, we'll be focusing on the credit decision, wherein I would like to cover the following topics. I want to talk about what is credit actually, the proper definition of credit, what do we mean by credit risk, and when we are performing credit analysis, what do I mean by that? What are the different components of credit risk? And what do I mean by credit risk mitigation? How do I reduce the credit risk? And what are the couple of types or which are called as credit risk mitigants? What are the different types of credit risk mitigants which are commonly used in the industry? Then, how do I really differentiate between a person's willingness to pay the loan amount versus capacity to repay that? How do I differentiate these two words, willingness versus capacity? And while doing a credit analysis, what do I mean by quantitative and qualitative elements? How do I differentiate between credit analysis and credit risk modeling? What are the different kinds of credit analysis that are typically performed, like individual credit analysis? How do I perform for an individual? Non-financial companies, how do I do a credit analysis? Financial companies, what is the kind of credit analysis I can perform? So we are trying to look at different forms of credit analysis. And then how do I arrive at the quantitative measure of credit risk? And towards the end, we really want to highlight an important concept. What is the difference between insolvency and failure? And how do I typically link it up with the banking world? So these are the different topics that we are taking up in this session. So to get started, look at the definition of credit. It's a realistic belief, right? Our expectation. I'm having a very realistic belief upon which a lender is willing to act. So now it is based on a lender and a borrower. Right? The borrower is asking the lender for some funds and lender is actually lending those funds to the borrower. Now, so lender is having a realistic belief or expectation that the fund that he has given to the borrower will be repaid by the borrower at a future date in accordance with the agreement. So they have written an agreement that borrower will have to pay an interest, let's say every year, and the principal at the end of 3 years, whatever it is. So lender is having a realistic expectation that the fund that he has advanced will be repaid in line with the agreement that is made between the two parties who are the lender and the borrower. That is what we are calling as credit. So which means it's a transaction in which one party is giving funds to the other party under a very realistic expectation that the person who has taken the funds is going to repay them at a future date in accordance with the terms and conditions that they have mentioned as a part of their agreement. That is what we are typically calling as credit. So we are expecting the money. As a lender, I am expecting that my money will come back within some limited amount of time. So I am giving it today with an intention that I will get it back within some limited amount of time. So here we are talking about two fundamental principles that are driving the whole definition of credit. The lender is very comfortably assuming that the borrower is and will be willing to repay the fund. So it's like willing. It's something to do with the behavior of the borrower. So the lender is believing that the borrower is willing to pay, the borrower will be willing to pay even in the future. And at the same time, he is also assuming that the borrower has the capacity to repay in the future. And he will have the capacity. Capacity is more of a financial element, right? Ability. So he is having the money to repay. He will have the money to repay. So there are two aspects the lender is assuming about the borrower. The borrower has the willingness to repay as well as the capacity to repay. So these two fundamental principles are driving the world of credit. So whenever we are performing a credit analysis, we are trying to assess what is the chance, what is the likelihood that the borrower is going to fulfill his financial obligation, because the lender is making an assumption that the borrower is willing and he will have the capacity. Need not be the case 100% of the time. The lender has taken a risk and he has advanced the funds to the borrower. Now, what is very much necessary to understand is what is the chance that the borrower will pay back the money as per the terms and conditions in the contract. Now, if I say if that probability is close to 100%, then it means that the creditor is not having much of a loss. The chance that the creditor will have a loss is much lesser, which means the credit risk is much lesser. So if I am trying to assess the credit analysis of a person, I am looking at what is the chance that this particular party will default on the financial obligation. The higher the ratio is, right, what is the probability that the person will repay as per the terms and conditions of the contract. If it is close to 100%, the chances that the lender is going to get into trouble is much lesser, which means associated with that particular credit, the risk is much lesser. That is how we are linking the world of credit with credit risk through credit analysis. So coming to the world of credit risk, there are different scenarios where this credit risk can occur. Look at these transactions. Okay, I've done the service to my client. My client has asked for ABC activities to be performed. Right? I have done the services for the client. So my activity with the client is done. Now I have sent a bill for the whatever the services that I have performed, and I am yet to get the money from my client. Now this is a scenario where one party has performed the activity, but he has not yet received the payment for the services that he has performed. So that's a typical scenario where credit risk can be present, because if this party defaults in making the payment, then that's a question of credit risk. So this is a scenario, an usual business scenario. One party performs the services and he sends the bill, and the other party has to respond with the payment. So there is a time gap there, and that kind of credit is what we are calling as a trade credit, regular trade kind of activity. Similarly, there could be a scenario that I have made a payment in advance to my vendor and I'm yet to get the goods from that vendor. So I have done an advance payment. So from my side, I have made a payment that I'm yet to receive the goods from my vendor. So that is also a kind of a credit scenario. And in that case, we are calling it as a settlement risk. One side has made the payment The other side is yet to settle that particular payment by the delivery of goods and services. Even there is a possibility that the person who has taken the money in advance might not render the delivery of the product. So even that is an example of credit risk. And the third scenario especially comes with very large capital goods, high cost goods, wherein there is a possibility that the seller himself gives some kind of installment opportunity or some kind of an explicit financing term. Very commonly, it's an installment opportunity that the seller will give to the buyer for buying that particular high cost good, which is like he is giving a kind of a bank loan similar to that of a bank loan to the customer. So in that scenario, where the sellers are offering some kind of explicit financing terms, even there the person can very well take the item and probably he may not fulfill the loan or he may not fulfill the financing terms and contract terms and conditions set as a part of the contract. So in all these scenarios we see that one party can very much renege on the contract, renege on the agreement that has been done as a part of the contract, and which may very well result in credit risk. Only when there is a simultaneous exchange of goods and cash, where there is no time difference between these two. One party has delivered the good, the other party has made the payment in terms of cash. Only there I don't see any kind of a credit risk. But every company does have some kind of credit because it has to sustain the competition. Not every kind of activity can be cash based activity. There could be a credit based activity, and wherever there is a credit based activity, credit risk is inevitable. Only when there is a simultaneous exchange of goods for cash, that is where we see credit risk will not be present. Cash and carry transactions only will eliminate the credit risk, but literally speaking, it's not that feasible for any business to run on a complete cash and carry kind of a basis. And that too, when I'm talking about the banks whose real existence or whose core objective itself is purely based on credit, they cannot eliminate the credit risk at all. It's a part of the business of the bank. Credit risk is a part of the business of the bank, and their regular operation itself is take money from the depositors at a lower interest rate, give loans at a higher interest rate, and make the difference as their income and the profits. Now, this means that they are typically engaged in the process of credit itself. So a bank cannot avoid the credit risk. The only thing it can do is effectively select the risk and effectively manage the risk. So it has to do a proper assessment of the risk, but it can't avoid the risk at all. If that's the case, the bank cannot perform its business at all. So there is a lot of activity that goes in estimation of the credit risk and come out with apparent mechanisms, appropriate mechanisms to handle and mitigate the credit risk. So that is one thing which has to come out in this entire activity. Now comes the next activity, which is performing credit analysis. So whenever I am saying that I have to perform credit analysis, what is that I have to look at? What is causing credit risk? What are the different causes? what are the different sources of credit risk, so that in every transaction I can really evaluate whether it is present or not, and based on that I'll do the pricing of the credit risk as well. So when we talk about the credit risk, we are talking about a loss that is coming because of one, default of the counterparty. Okay, A and B have got into a contract. So A has lent money to B. So B has borrowed. So which means at a later point B has to typically make the payment to A. But if B has defaulted in terms of making the payment, then that's a credit risk because it's a loss that is coming to A. Similarly, it's just not the default, even if the probability of default increases. So if it is getting sensed that the chance that B will default in the future will increase because B's business is not doing well or whatever could be the reason, the chance that B will default in the future is increasing. Even then, the chance that the loss that would be borne by A is going to increase. So that is also a possibility of credit risk. It's just not a default. Even if there is an increase in the probability of default, that is also we are classifying as credit risk. And a higher than expected loss severity. So when we talk about the credit risk, we talk about two elements, right? The probability of loss occurrence as well as the severity that is resulting in the occurrence once the loss has occurred. So this severity could be again based on two aspects. One, my recovery rate could be much lower, right? Once the loss has occurred, I thought that I can recover 50%, but in reality I am able to recover only 20% from that person. So even if the recovery rate is going low, then also I say that the credit risk is cropping up. Or even the expected exposure at the time of default is higher. I thought that the whole amount that is at risk is 1 million, but it has, at the time of default, it came out that the exposure that is at risk is 1.2 million. So the expected exposure at the time of default, if it is going up, even then the chance of loss is increasing, which means the credit risk is increasing. Or it could be the case that the recovery rate has gone low, which is also increasing the credit risk. So that's one more scenario where the credit risk is going to go up. And the other one we have already talked about, the settlement risk, where one party has made the payment for goods and services, but the counterparty did not get back with the delivery of the goods or services, rendering of the goods or the services, which is what is another form of credit risk, which we call as settlement risk. So credit risk is typically the loss that can occur from any of these kind of transactions. And when we are now getting into analyzing what are the various variables that are affecting the credit risk, the first and foremost thing we talk about are the two dimensions of the borrower. The capacity, the financial capacity or the financial ability of the borrower in terms of meeting the obligations, and two, the behavioral aspect, which is the willingness of the borrower to meet the obligation. So that's one major dimension we have to assess. What is the capacity and the willingness of the obliger to meet the obligation? Then we will also look at the external environment, not between the borrower and the lender. Look at the operating conditions. How is the business scenario in the country? Is it good? Will the businesses prosper? Will people be able to make money? Or is it like everyone is ending up into losses? So look at the operating conditions. Country risk, country as such, what is the kind of sovereign ratings the country is having, what is the kind of situation the country is operating in, political, economic, all the kinds of stuff. What is the kind of business climate that is there in the country? Because these are the ones in general, they affect all the companies in that particular country. They are the ones that are going to impact the probability of default. They can increase, if they are all worse, they can very well increase the probability of default of every company, and even the severity, loss severity is going to increase for every, and even the exposure that is at default can increase. So just have a watch on the external environment, how it is going to operate in the particular country which you have chosen. So one, we are looking at the borrower himself, the capacity and the willingness. Then we are also looking at external environment. Then we are also looking at the characteristics of the credit instrument that we are looking at. Right? If we could look at loan, the different characteristics of that, or probably I can talk about the bond, which is also a credit instrument. So I'll look at, and in this bond there could be different kinds of bonds. So I look at the different characteristics of that credit instrument. Like, okay, what is the facility? What is the issue? What is the debt security? Is it a loan? What are the different characteristics? The maturity, the way in which the payments are typically being made. Are there any specific features? We'll try to go ahead and look at this in detail. But yes, so the third thing that I'm going to look at is the instrument itself, the different characteristics of it. And the fourth thing that I have to see as a part of the credit analysis is, are these supported with any kind of credit risk mitigants? Are they supported with any kind of collaterals, guarantees, or any kind of enhancements which are going to reduce the credit risk? So these four dimensions. So basically, if you look at, one is the individual or the borrower. For the borrower, I am looking at the capacity and willingness. Then I am looking at the external environment, where the economy, the country, that's the entire thing I am dealing. Then I am dealing with the instrument itself, the characteristics of it. And finally, I am looking at the credit risk mitigants, which can enhance the credit worthiness of the company or reduce the credit risk associated with these transactions. So as a credit analyst, I am focusing on these four dimensions. And along with that, I am also looking at length of the time. Because what we see is, the longer and longer the time period for the borrowing. So it's like, if I have to repay the loan in 20 years versus repaying the loan in 2 years, the chance that a 20-year loan will be defaulted is much higher compared to a chance of a 2-year loan. So the length of the time for which the credit exists is also one more important criteria to look at. And especially if I am talking about multiple assets that are there in the portfolio of a lender, the correlation between the different assets is also an important activity that needs to be evaluated. So correlation means probably the chances of default. Okay, if this is defaulting, if there is a high chance that even this will default, like this is a loan to a company 1, this is a loan to a company 2, company 3, company 4. If company 1 defaults, then there is a high chance that company 2 also is defaulting. Then make sure that you don't give the loan to company 2, because if one of them is defaulting, the other is also defaulting heavily. So that is what we are talking about, the correlation among the particular assets along with the level of concentration on each of the asset classes. So this is also one more thing that is performed as a part of extensive credit analysis. So in a credit analysis, first we are trying to understand What is the kind of losses that are occurring? What do we really mean by credit risk? What kind of losses come under the category of credit risk? And what are the different kinds of variables that are affecting the credit risk? So we are looking at one by one. So first focusing on capacity and willingness. So what is the capacity of the borrower to pay the financial obligations? What is the probability that the borrower is going to make all the interest and principal repayments as per the terms and conditions mentioned in the agreement? What is the probability? So here I can very well look at the business of the obliger or the borrower. What is the typical credit risk characteristic of the business or the obliger? What is the corporate structure of the business? Will it prevent the payment of the debt? What is the critical ownership? Is it concentrated in the hands of a few individuals, or is it much more publicly held? What are the kinds of policy obligations which can impact the paying capacity or the willingness of the borrower to the lender? So that is one dimension that we are looking at. Then externally, I am seeing the country risk, the operating conditions in the country. What kind of impact will it make the people to default more, or will it make the people to pay more? Any cyclical secular changes that are going to come up in the economy? Is it a cyclical kind of and is the company working in a cyclical kind of an industry, or is it not affected by business cycles? So we are looking at these kind of conditions that are going to affect the country, which could affect the paying capacity of the company. Then we are also focusing on the credit characteristics of the obligation itself. What is the maturity? Is it for 5 years or 20 years? What is the kind of security that is associated? Is it secured by some kind of collateral, or is it completely unsecured? What is the kind of priority in case the company goes bankrupt? Who will be receiving the first set of payments from the company, and who are the last to receive the payment? So senior debt is that kind of a credit where once the company is liquidated, once the assets are liquidated, the proceeds are first distributed to the senior credit holders, then to the subordinate, and then to the unsecured. So what is the priority in the entire structure? The higher is the priority, the lesser is the chance of credit risk, and vice versa. Similarly, I am looking at specific terms and covenants that are suggested by the lender to the borrower. So like some particular ratios need to be maintained during the credit period, or no new borrowing can be done until the existing loan is typically paid off. Some such kind of things, or no dividends can be issued to the shareholders before the payment of the debt, or before consulting the lenders, no new dividend can be issued to the shareholders. Some such kind of terms and conditions, specific terms and conditions, if they are there as a part of the agreement. And we are also talking about call or convertibility provision, which is there with the bonds. A callable bond is something that the issuer can very well call back for a predefined price at a future date. So he'll generally do it when it is favorable to the borrower. Similarly, we can have a convertibility provision. Initially, it could be a bond, but it can have the provision to get converted into an equity. So, is there any such kind of a provision that is there on the bond? And what is the currency of the obligation? Is it in dollars? Is it in Indian rupees? Or in which kind of currency it is there? Because we have to assess the fluctuation of that particular currency, the volatility of that particular currency, the expected value of that currency at a future date, and then translate it into the domestic currency. So we have to really assess the credit characteristics associated with the currency, and if there is any other contingent derivative related risks that needs to be evaluated, and not the least, the legal risk that is associated with that particular jurisdiction also needs to be evaluated. So there are different credit characteristics that are associated with the obligation, which we have to really evaluate and interpret in depth. And similarly, we are talking about the fourth dimension, if there are any kind of credit risk mitigants. So something which can reduce the chance of default, or even if the default occurs, there is some kind of a backup which can minimize the loss to the lender. Those are what we are calling as mitigants, where the whole thing we talk about revolves around the collateral that is being used, or am I using some kind of a secondary obliger or a guarantor who is guaranteeing the payment in case the primary borrower is defaulting? So for me now, I have to really evaluate the capacity and willingness of, or the financial strength of, the mitigation that is being used, the mitigant that is being used. I have to really evaluate the financial strength of that. So whenever we are doing the credit risk analysis, we are doing this four-dimensional analysis. We are looking at the obliger or the borrower himself, capacity and willingness to repay, look at the broad economic environment of the country, then look at the instrument itself, the credit characteristics of that, and if there are any kind of credit risk mitigants that are attached to this particular contract. I have to spend some time in terms of talking about the credit risk mitigation, because the major challenge that comes out is the degree of uncertainty. I know that I have to forecast the probability of default. What is the chance that the borrower will pay back as per the terms and conditions of the agreement? But the biggest challenge lies in forecasting that probability of default, coming out with more and more accurate forecast of the probability of default. So this is where the lender, he can't shy away from giving the loan, though he knows that it's not 100% guaranteed that the borrower is going to pay. I'm reasonably expecting that the borrower is going to repay, but I can't be 100% assured on that. So this is where the lenders, they try to seek the security in the form of collateral or guarantee. And this is what we are calling as the credit risk mitigant. They are like enhancing the quality of the loan. So they reduce the credit risk exposure for the lender. Because if the borrower has defaulted, the lender can very well sell off this collateral and get the money out of it. Or he can he can force the guarantor to make the payment if the original borrower has defaulted. So even if the borrower's credit worthiness is much lesser, still the lender can lend to that borrower because there is a kind of a backup that is existing for the lender. So he can very well give even a larger sum of money to the borrower, which he might not have given if there was no collateral taken. So in some cases, we talk about even an insurance policy acting as a collateral. And here, nowadays, this collateral is becoming a requisite and an integral element of every credit transaction. To a large extent, to a large number of credit transactions today, we see collaterals or insurance or guarantees, pledges, something is acting as a credit risk mitigant. And when we are doing a real life credit analysis, we are always looking at an integrated approach. We are not isolating each of these pieces. We are not isolating the collateral and the underlying instrument. We can't isolate these two and we can't look at these two separately. I have to look at the integrated approach to the credit decision. So I have to, or even the obliger. I can't look at evaluating obliger separately, the credit instrument separately, and the credit risk mitigant separately. I have to consider all of them together. An integrated approach to the credit risk assessment and management is what I have to do in the real world. I have to look at the credit risk mitigant, to what extent they are reducing or mitigating the loss that is expected to the lender. Now, when I have to deal a little bit more into this types of credit risk mitigation, we talk about two broad types, the collateral and the guarantee. So collateral are those kind of assets which are securing a loan. So what I do is, as a borrower, I conditionally assign, let's say I am keeping the car as a collateral for a loan that I have taken. I am keeping my car as a collateral. I am conditionally assigning that car to the lender. And I will get it back after I do a full repayment of the fund that I have borrowed. And in case I don't make the payment, make the interest and the principal as per the terms and conditions in the contract, the lender is having the right to get the title and possession in full or partial. So if I don't pay, to the extent that I have not paid, the lender is having all the right to get the title and the possession of that particular collateral. So in a way, the lender is becoming a secured creditor there, because even if I don't pay, he is not losing out fully on that. He can very well seize that collateral and he can sell it without even initiating the bankruptcy proceedings. But if it is an unsecured loan, still they can get the proceeds from the borrower, but for that they have to initiate the bankruptcy proceedings. Whereas if there is a collateral that is existing, I can bypass the bankruptcy proceeding process, directly sell the assets of the lender, whatever the asset that has been assigned as a collateral, those assets I can very well sell off, use that proceeds to the extent of the loan that has been given to the borrower. And from the borrower's perspective, if I am looking at the advantage of a collateral, borrower is keeping a car as a collateral with the lender. Now, the borrower is also under a kind of a worry that if he does not make the payment of the loan, he will lose his car, he will lose his asset. So that also gives a kind of a motivation for the borrower to try hard to repay the loan. So even from a borrower's perspective, there would be an effort in terms of repaying the loan, which will in a way reduce the probability of default. And even from the lenders or creditors perspective, the severity of the loss is also reduced. So that is how the credit risk mitigant is really helping in improving the credit worthiness of the counterparty and overall reducing the credit risk to the lender. So it's as good as saying if a pawnbroker lends money against a gold watch, he does not need to do the credit analysis of the borrower. In fact, he just needs to know what is the worth of the watch. Because if the borrower is not paying, the only thing is he can sell the watch. And if he is getting much more out of the watch than what is the loan that the borrower has to pay, he is least bothered. Now the onus is on the borrower in terms of making the payment. So that's how collateral becomes a very powerful tool in the entire credit analysis. Similarly, another tool that plays an important role in credit risk mitigation is the guarantee, which is a promise by a third party to accept this liability in case the primary party fails on paying off its debt. If the primary borrower is defaulting, it's a promise that one more person is willing to accept this particular responsibility that he would be clearing the debt of the primary borrower. So there is a guarantee that is being given by one party on the loan that is taken by the other party, which will again increase the confidence of the original lender. So now the original lender has to evaluate the credit worthiness of the guarantor. Because overall the credit risk or credit analysis is not getting eliminated here. The only thing is now the obligor has now the lender has to do the credit analysis of the guarantor, and he may not be needing to do the credit analysis of the original borrower at all. So that could be a difference, but still credit analysis has to be performed in case of guarantee. Whereas in case of collateral, if I just know the worth of the collateral, it's as simple as obtaining the. If the collateral worth is known, you don't need to really assess the borrower's credit worthiness at all. Now let's look at a couple of important dimensions. One on the willingness to pay. It's a subjective attribute, mainly dealing with the reputation of the borrower, the character of the borrower. It has nothing to do with the financial. It's more and more a behavioral related attribute. Is he really willing to pay? He may have the money, but he may not be willing to pay. So it's a more and more of character associated kind of a attribute. So the evaluation has to be more and more qualitative. Generally, the evaluation is done through face-to-face meetings. Perform a due diligence, understand what is the character of this particular person. Traditionally put, if you look at the banking few years or few decades back, the traditional banking, which was majorly concentrated for the local businesses in a particular geographical area, everyone knows, the bank knows each and every individual. Right? So there is no need for formal credit analysis. But today every bank is spread in every city. The bank manager may or may not know the individuals who are borrowing. So now it is the process that has to be streamlined rather than a face-to-face understanding of the person. So this is where we are looking at the different kinds of indicators which talk about the willingness. So there have been some kind of indicators that have been designed to really assess the willingness, though they may not fully replace the understanding of the borrower in person, but at least some kind of automation, some kind of assessment, some kind of indicators talking about the willingness. Look at the character and the reputation of the person. So get a first-hand awareness of the character of the borrower. What is his reputation? In some cases we call it as name lending. So based on the name and the reputation of the person in that particular country or in that particular locality, the lending is being done to that customer. So you try to find out the character of the person in the locality, and based on that we are doing a lending. So it's a reputation based lending or a name based lending. So that's one way we can look at the willingness, because it's the individual name and reputation that matter a lot. Then we are looking at the historical credit records. So historically, did the person meet all the obligations on time in the past? So we are assuming that the same pattern of repayment is going to continue in the future, which may or may not expected with certainty, but it's a decent indicator which talks about the willingness of the repayment of the borrower. Then we are also looking at what are the different kinds of rights and the legal system in the jurisdiction of the creditor. How supportive is the legal system of the country in support of the creditors? Is it creditor friendly or debtor friendly? So we have to do assessment of all these things. See, if the capacity is not there, now look at a slightly different dimension. Let's say a person is not having the capacity, means he is not having the ability to repay. He has no funds to repay. If he has no funds to repay, then obviously there is nothing to do with the willingness. So, if he is having the capacity but he is not willing, that is what will be a big cause of concern. But if his capacity itself is very poor, then there is nothing much to talk about on the willingness front. So, this is where we are talking of, if a person has a capacity but not the willingness, then if the legal system in the country is very effective, means if the creditor can go to the court and get the recovery from the borrower, then willingness is something which the creditor need not worry about at all. Right? Because the legal regime will take care of that. But wherever we are seeing, whichever country, whichever jurisdiction we are seeing, that the borrower is having the capacity but he is not willing to repay, it means that he is taking an advantage of the legal system in that country, which is either ineffective or corrupt. So I have to really evaluate what is the legal system of that particular country. If it is more and more creditor friendly, the lender need not worry about the willingness part. He just needs to do the assessment of the capacity of the borrower. Willingness will be taken care by the legal system. So, more and more efficient legal systems, they can provide a benefit to the creditors. But today in the developed market, that is the case, but definitely not in the developing or less underdeveloped kind of markets. And we can very well assess which market is developed versus which market is not developed, or in which market the legal system is efficient versus where the legal system is inefficient. I can very well look at sovereign risk ratings as the proxy. If the ratings are much lower, it means the risk is higher with respect to that particular country and the legal system, and there is a good chance that the borrower can have the capacity but he may not be willing to repay. But at the same time, probably yes, a good legal system will ensure that the borrower will repay if he is having the capacity. But at the same time, try to understand that the cost of the legal services also forms an important aspect. Because in many cases, what could happen is, if I am the lender, the borrower did not pay me on time. I want to approach a legal system, but my legal costs, the fee that I pay to a lawyer and various other activities, is going to be exorbitantly higher. And because all these costs are going to be exorbitantly higher, I may better feel not to go for a complaint. So if that's the case, though the legal system is efficient, but because it's not cost effective, I may not take the help of a legal system at all. So that's one more dimension that I may have to look at from the willingness to pay kind of a perspective. Because I'm not ready to pay to take legal action against a borrower who has defaulted. So even in that case, the borrowers can very well show their unwillingness to pay, though they are having ample capacity to do the payment. So there's one more dimension which has to be assessed very clearly before making a kind of a loan to any of the borrowers, prospective borrowers. Then, just like the way we have evaluated the willingness, we are also looking at the capacity. The capacity to repay is a pure quantitative measurement where we are applying the financial analysis to understand what is the kind of ability the borrower is having to fulfill all the outstanding obligations. So we are purely looking at the numerical data from the financial statements, recent, past, all kinds of financial statements. So we are doing a very in-depth ratio analysis to really assess the capacity of the borrower to repay. But we have a few limitations there. One, the financial data is purely historical in nature. Old data need not be a reflection of the current situation of the company. So past cannot be extrapolated into the future with 100% accuracy, which means some level of uncertainty in the forecast can very well exist when I am relying on the historical data. So there will be a lot of difficulty in making accurate financial projections based on the historical data. Some kind of errors and distortions are very much possible. I have to accept that fact. And there could be an inevitable gap between the financial reporting and financial reality. Financial reporting is based on the GAAP and IFRS, which are the reporting standards that are being set. And those standards are created by people who have different perspectives and different interests. They may not match with the reality altogether. And it's not that easy to design the rules for almost every situation, every transaction. So obviously there has to be some kind of a discretion that has to be given to document different kinds of transactions, which means the comparison across the different companies will become difficult because different companies will document the same transaction in different ways under the different headers. So there could be difference in the way the experience, the skill may result in. See, at the end we are talking about evaluation, analysis. It's not mathematics, it's a decision, it's a judgment. From the numbers, how well I interpret, how deep I go into my interpretation. So that depends on the experience, analytical skills, and may range in a different kinds of conclusions from the data, which also clearly indicates that though the data that is present is the same, different people can come out with different analysis and different conclusions out of it. So that is where the quantitative kind of models will have their own limitations. So which means while doing the capacity assessment, though quantitative assessment is an important part, I can't rely 100% only on the quantitative numbers. I have to use my judgment as well. So I have to go with a combination of both quantitative as well as qualitative, where even I have to look at the management per se. What is the level of competence, motivation, incentives that are there for the management? And I may also look at the strategy that the management is following. What is the plausibility of that particular strategy? What is the coherence of that strategy? So which means I am using the credit analysis as a science where I am building up mathematical models and evaluating the same, and also looking at it as an art. So there is a judgment angle in it as well as the mathematics angle, and I have to be very comfortable at both the activities. So we are using both the qualitative as well as quantitative measures in trying to assess the credit worthiness of a particular counterparty. Now, here I have to bring one more distinction. It's a very common thing people talk about: credit analysis versus credit risk modeling. Analysis is where I'm looking at the counterparties. One single counterparty, I am evaluating the credit worthiness of that particular party. Right? So I'm doing a counterparty credit analysis, whereas when I'm doing credit risk model, I'm looking at what is the overall risk of the company at an enterprise level. How can I mitigate the credit risk at the enterprise level? So as a credit analyst, I am not doing any kind of a modeling. I am evaluating one single counterparty, which could be an input into the building of the credit risk model, but I am doing only the evaluation of a particular a particular obliger, or a particular credit instrument, or even a credit mitigant. I am looking at only one specific counterparty evaluation, one specific credit evaluation. Whereas in the credit risk model, I am looking at a much bigger picture. So I have to really differentiate between these two words. Now, when we are doing the credit analysis, we need to know what kinds of credit analysis that we are performing. So that is where we are doing the categorization, which is primarily done based on the type of borrower. So there are four broad categories which we talk of. Consumer credit analysis, where we are looking at the creditworthiness of the individual consumers for an individual home loans, vehicle loans, etc. Then I am looking at corporate credit analysis, where I am looking at non-financial companies, manufacturing companies, service companies, which are non-financial, doing the credit worthiness of those companies. Then we talk about financial institution credit analysis, where the assessment is of banks and non-banking financial corporations, insurance companies, hedge funds, mutual funds, all these kinds of firms. We are trying to evaluate their credit worthiness. That is what we do as a part of financial institution credit analysis. And then when we talk about the sovereign or a municipal credit analysis, we are talking about the country per se, or subnational governments like states, provinces, or state government kind of entities. So we are doing a credit analysis of these different parties, comes under the sovereign or a municipal credit analysis. So going with each of these things in depth, when I'm doing an individual credit analysis, I'm simply looking at an individual borrower, probably for a housing loan or a vehicle loan or some such kind of loans that he is going to take. So here the main criteria is the wealth that this person is having, the net worth that this person is having. So that's the measure of capacity. The higher is the wealth, I'm very much assured as a lender that this person will repay the things back. So the wealth is a very important measure of the capacity, which I will look at as the surplus of the assets that he is possessing over the debts that he is carrying. So the more and more positive that number is, the more I am willing to give him a loan. The lesser and lesser it is, he becomes a risk towards the extending of any kind of a loan. And along with that wealth, I am also looking at the incoming cash, salary, return on investments. So the more and more he is getting, the more confidence as a bank I am getting that he will be repaying the loan in the future. But if you look at it on a very broad scale, the overall assessment of individual credit, small amounts, at the max, the cost of house. So the amount wise, they are comparatively small when you look at the overall portfolio of the bank. More or less every person will have similar kind of characteristics. The loan characteristics are more or less similar. Financial statements of each of the individuals would be more or less similar, not much of a deviation in the same. But the number of transactions are very many. Every person, every house might go for a house loan. So the number of transactions that are involved are very large in number, and there is a lot of data that is available with the bank. So it can very well come out with some kind of quantitative model for the assessment of the credit risk. Right? Now, even on the other side, when we look at the default that is done by the customers, one, they may lose their job, and because of that there could be a loss of income, or there could be the economy could be in such a way that the expenses have gone exorbitantly higher, or some emergency has come out with respect to the medical problem of a person and he does not have medical insurance, and the cost of the medical treatment is much higher, that he will not be in a position to pay the obligation on time. So the default, these are the very common scenarios of default in case of individual loans. So because I know to a large extent, I have the data, I know the drivers that are causing the default. So to a large extent, this entire individual credit analysis is typically automated using the credit scoring models. Some kind of statistical tools are being developed wherein I can map the default with a limited set of variables and design a model for assessing whether a particular loan is going to default or not. The reason we do it automated is, what has been found out is, it's not that cost effective to perform a full-fledged evaluation of an individual, detailed understanding of the credit quality of the individual. One, because the amounts are much lesser, and two, the administration costs could go much higher. So it does not make any kind of cost effectiveness doing a full-fledged evaluation, using a detailed analysis of the financial statements of the individual. So it's always better to rely on automated using of the credit scoring models itself for individual credit analysis. So that's one part that we really need to understand. Then coming on to the non-financial companies, though we can say to a large extent their characteristics are on the same lines as that of the individual, because instead of an individual borrowing, it's a company that is doing the borrowing. So at the outset, it can appear that there is a lot of similarity between an individual borrowing and and a company borrowing. But a few things that are significantly different: their assets. The character of their assets is different between the companies and the individual. Regularity of the income stream. So there could be monthly salaries. Here the regularity of the pattern could be different, may not be a fixed amount every month. And the requirement of cash is different time frames at which the cash is required. The debt to equity structure could be different among the different companies, and the correlation that is existing between each of these characteristics could differ, which means though at the outset it looks like the borrowing of the non-financial company is similar to that of an individual borrowing, In reality, there are good number of structural differences that are existing between the two. And also, even when we look at the money, the amounts are not smaller in size. There is a huge amount of fund that is at stake. So, which means I can't just do a kind of credit scoring model to assess the non-financial company. We are doing much more detailed hands-on consumer credit analysis, or we are doing the non-financial companies financial analysis. We are doing more and more in-depth compared to individual credit analysis. And so we are looking at evaluating the bonds and loans in depth. The focus is more on the liquidity of the company. So we look at a few liquidity based ratios like the current ratio, quick ratio, etc. And we are evaluating the cash flow of the company in depth, profitability of the company, near term earnings capacity of the company we are evaluating, and taking them as important factors as a part of the financial condition of the non-financial company. And we are also looking at the solvency, the capital position, the debt to equity ratio, kind of financial ratios we can look at to assess the solvency of the company. So we are evaluating the financial condition of the non-financial companies through a slightly more stringent kind of an approach. And when it comes to evaluating financial companies, the activities that take more and more priority, the liquidity of the bank is a very important element. The solvency of the bank is very important. Operations wise, I am looking at the historical performance. So numbers wise, I may look at these kind of numbers. But along with that, I am also focusing on the qualitative aspects like the competence of the management, the state of the economy, the industry to which the bank has lent heavily. They are all considered to assess the worthiness of a bank or any financial institution. A few important things that we look at: the earnings capacity of the bank, where we are trying to talk about what is the potential of the bank to generate operating income on the net income on a very consistent basis in the future. To what extent I can ensure the consistency of operating income and the net income of a particular bank. What is the potential of a bank's business to generate sustained and consistent net income and net operating income every year? Then we are talking about the liquidity, where we are focusing more on cash and cash equivalents. What is the kind of sufficiency of them, adequacy of them to meet the current obligations? Then the solvency in the banking world we are calling as capital adequacy, which is a kind of a cushion or a kind of a backup the bank is having against its liabilities to the depositors and the bank creditors. In case the depositors are demanding or the creditors are typically demanding, what is the level of backup the bank is having to make the payment to the investor, to the depositors and creditors? And one major aspect which differentiates a non-financial company to a finance company is the quality of the asset. Whatever is the loan that the bank has given to its customers, what is the quality of that loan? To what extent I can really be confident that the loan will be repaid by the borrower? What is the level of collateral the bank has collected from the borrower to ensure that the loss is very, very minimal? So the quality of those assets become a very important part as a part of assessment of a financial company. So here we are not that much bothered about the cash flows. So that's one different dimension. When I am evaluating the bank or a financial institution, I am more and more bothered about the asset quality, the liquidity, but not much in terms of the cash flow. And But this entire analysis, again, it differs very differently again, across the different companies that are present in the financial sector. The way banks operate is different from the way a non-banking financial corporation is going to work. So, though these are the important elements for evaluating a financial company, this may differ again significantly across the different constituents of the financial industry as well. Then, taking on the quantitative measure, if I have to do a quantitative measure of the credit risk, what are the different elements that go into it? First of all, a definition of the credit risk coming out with the likelihood that the borrower will perform a financial obligation, or it's finally tending to the probability that it will default on the commitment, and which will lead to the probability that the lender will suffer a loss because of the default of the borrower. So here the word probability of default of the borrower on the obligation is a very important aspect, which is what is going to differentiate a good credit from a bad one. But if I look at it, the probability of default may or may not be a big concern. Look at it like this, okay? The person has defaulted, but probably within no time he has made up for that loss, for that default. He has made the penalties. He has paid all the penalties. All the backlogs are cleared, and he has given a kind of an assurance that similar kind of thing is not going to repeat in the future. Then it's not a big loss to the borrower, to the lender, because he has rectified. He has made the penalty payment, and he has even given an assurance that the same thing will not repeat in the future. Right? But what we could also see is, in some cases, even if there is a delay in the payment, the lender will go into serious liquidity problems because the lender might have got the money from somewhere else to whom he has to make the payment. So we can't say that it's just a default that is a cause of concern. Even a delay in making the payment also is a cause of concern. It's not a matter of that delay resulting in a penalty and paying a penalty, but because of that delay, the lender's position may go into difficulty, as there might be some more loans that are taken by the lender to from some other source which have to be repaid. So that is what we have to look at. It just not probability of defaulting. Even a delay in the payment also could have a serious repercussions sometimes, and in some cases, even if the delay, if there is not too much of a responsibility for the lender to do any kind of payment, then a slight delay rectifying the error can very well will not affect the lender in any way. Similarly, one more dimension that we look at is loss given default, which talks about what is the percentage impact in case the default is going to occur. So it's a kind of a measure associated with the severity of the default, which is again based on the recovery. Right? If the default occurs, to what extent I can recover, and what is the percentage that I may lose. So this is the case when I don't expect any kind of payment in the future. Right? The payments are ceased. The borrower is no more in a position to make any kind of payment. So the recovery is not possible beyond this. And that's a kind of a substantial loss to the lender. That loss, we are expressing it in terms of percentage, calling it as a loss given default. And while measuring the credit risk, we are looking at both the probability of default as well as the severity of the loss. And the third one, which is very important in as a quantitative measure, is the exposure, which is at default, which we are looking at it as a percentage of the nominal amount of loan. Right, which is typically talking about how much of loan is still outstanding at the time of default. It may be a full amount or it may be a part of it. So whatever is the amount that is outstanding, that is what we are calling as the exposure at default. Either I can express it as a percentage of the nominal amount, or I could very well express it in dollar terms. So that's an exposure that is there at default. And using these three, we are simply computing the expected loss by multiplying the probability of default with the loss given default with the exposure at default for a particular time horizon. That is what we are getting as an expected loss. Generally, we assume that time period is 1 year for doing comparisons and analysis, and it's very difficult to estimate in advance, though I can take the help of the past data to typically make some kind of initial estimate. And as I said, time horizon is also one more important aspect. What is generally observed is the longer the duration of the loan, the chance that it will default is higher. And if we see this, the exposure at default will change with time, because the more and more new loans taken, EAD is going to be higher. Existing loan is getting repaid, EAD is going to be lower. So with time, EAD is going to change. Even the LGD, the loss given default, also will change depending on the specific terms and conditions and structure of the obligation. So if I have to talk about the four dimensions which are playing a role in terms of the quantitative measure of the credit risk, we are talking about one, the probability of default, two, the loss given default, then exposure at default, and the time horizon. These four are bundled together to come out with a quantitative measure of credit risk. Now comes an interesting aspect. With respect to the banking industry, I want to compare the word failure versus insolvency. A very interesting statement we can talk about in this regard. Major bank failure is relatively rare. The big banks, they hardly fail. Generally, what happens is a weak bank gets merged into a stronger bank. But of course, this is in normal market scenario. Very, very rare. Even if you look at the numbers historically, hardly 0.5% of the banks fail every year. It's a very, very rare scenario. But of course, during that recessionary period, 2009-10 kind of period, we have seen at least 2% of the US banks have failed. But it's not a regular phenomenon. Generally, what happens is the small local and provincial banks, they are closed by the regulators, they are merged without creating any kind of systemic waves, without affecting the overall financial system. We also have the definition of too big to fail kind of bank. They are so big that if they are failing, the whole financial system would be shaken. Those kind of banks are typically called as too big to fail, and they are typically supported by the central government and the central bank. Make sure that these banks don't fail. Even the same thing is felt by the banks also, that if they fail, the government is going to help them out. So those are the ones that are considered under the too big to fail category. So because of that, they are ready to take a higher risk, because they know if they are failing, the government is going to help them out. The central bank is going to help them out. Now that is where, as a part of the recent regulations, it came out that they have identified 29 such kind of institutions which are considered as too big to fail, typically called them as SIFIs, systematically important financial institutions. And for them, the regulation has come out that they have to use an additional loss absorption capacity. They have to maintain an additional capital just to make sure that these banks will not default. Because if they default, the understanding is they are going to create ripples in the entire financial system, and the entire country's operations are going to be shaken because of them. So because of that, this is a kind of a proactive measure that is being taken by the government. And here we have to differentiate between two statements: bank insolvency versus failure. Insolvency is a very common aspect. The reason is, insolvency is not failure in terms of banks, because even if the bank is insolvent, as long as there is a source of liquidity, typically we talk about the central bank as a lender of the last resort. So as long as there is a source of liquidity existing, which will exist to a very decent time, we see that insolvent banks can still keep continuing to do their business. Right? So here, when I have to really assess, I have to look at the episodes of distress that fall short of failure and they are causing harm to the investors and counterparties. Those are the ones that are typically need to be analyzed. So we have to very clearly understand that insolvency has nothing to do with the failure, and a bank can very well continue its operations even if it is insolvent. So if that's the case, why do I really need to perform a credit evaluation? Now this is where, if I look at a particular bank, right, I'm looking at different kinds of entities. What is the kind of exposure the bank has to each of the different kinds of entities? Now, I can rate each of these risks, and I can do the pricing of these risks accordingly as an analyst, and I can allocate the capital as per the regulations accordingly. So that's one of the prime reasons I have to do a credit evaluation. Even if the probability of default is low, at some point or the other, it can occur as well. So, I mean, even if I say the probability of default of this party is low, but yeah, slightly higher compared to this party, then the general thing that happens is, I want to avoid having the deals with this kind of a party. Possibility of default is going to be a worry. So which means, as a lender or as a kind of a transaction, I would like to have a transaction with this party because the probability of default is lower for this party compared to this party. So even for doing such a kind of prioritization, I may be interested in doing a credit valuation. And even if there is an event that is short of default, it's not a default, but a delay in the payment, even those can harm the counterparties and investors, as I have looked at earlier. And today, I am more and more bothered about the systematic contagion because of the globalization. So I really have to see what kind of systemic effects one is having or one is creating in the entire process. So that's one of the prime reasons I still have to do a credit evaluation, even though I know that bank insolvency does not necessarily mean the failure of a bank. And the default, whenever we are talking of, we are using it as a benchmark. I'm looking at the bank under review, where it stands in terms of financial strength. It's not purely creditworthy, it's not under bankruptcy, but where does it stand? So some kind of rating is what I'm assigning to each of the banks. And so there is a potential of failure that is being created through credit ratings, and which help in external pricing of the debt, and internally it helps in doing the allocation of capital accordingly. So that's one of the prime reasons we get into the credit evaluation of a particular bank. And if I look at in slightly more detail, When I look at from the dimension of pricing of the debt, I'm looking at the ratings yield curve. The better is the rating, the yield curve is much lesser. That is the kind of relationship which we are seeing. So it's a relationship between the credit risk and the return that will be required to compensate. So the higher is the risk, higher is the expected return. So the better is the rating, the lower is the expected return from the process. And this can still be used for allocation of the bank capital, right? One from a regulatory perspective and even from the bank's internal management perspective, it's a much more better aspect. The more I am able to evaluate the creditworthiness of a counterparty, I am able to allocate the capital accordingly. And this entire thing can really help me in terms of setting the exposure limits. What is the maximum exposure I can have with one specific counterparty, or each individual counterparty I can define the limits that I can get in, how much funds I can give to this particular counterparty, what is the amount of derivative transactions I can get in with this particular counterparty. I can have a very clear assessment on this entire process. So that's one more reason I do a proper credit evaluation. And sometimes even which are short of default, especially when I am losing access to funds, my funds are blocked. I can't access the funds for a temporary period of time. That could create a ripple effect on my entire operation. Right? Or even if there is another bank that has defaulted for a very short period of time, and because of that I'm not able to meet my obligations on time. As a result of that, my credit worthiness is actually coming down. So even if it is not a default, even if there is a delay in the payment, it's going to impact the credit worthiness of the bank. So even from that dimension, the credit analysis has to be performed with much more much more rigor. And what we also see is different banks are different. And within the banks also, when I compare the banking sector with the other sectors, the regulations are very heavy in the banking sector. So if there is a small change in the regulation or any kind of proposed change, it's going to impact the entire country in a much bigger manner. So that's the reason the governments across the world, they focus more and more on the health of the banks compared to any other industry, because they are considered as the backbone of any particular country's economy. So that's what we wanted to look at as a part of this credit decision. Understanding the definition of credit, looked at credit risk, credit analysis, the components of credit risk, different types of mitigants, speaking about the willingness to pay, how do I look at the capacity to repay, looking at quantitative and qualitative elements, differentiating between credit analysis and credit risk modeling, different categories of credit analysis focusing on individual, non-financial companies and financial companies. And we are looking at the quantitative measure, means what are the different components that go into the quantitative measure of risk, and how do I differentiate between a bank failure versus bank insolvency. So this is what I really wanted to offer as a part of this chapter. Thanks a lot for listening to this session. Thank you very much.